Thanks for joining us once again. This is Greg for Teslafaninsight. We've been away for a few days, one because of technical difficulties. The Mac kind of blew up that we're using for editing, as well as it's nice to have sort of clear logic versus throwing stuff out that has no basis for anything that's worth the time to watch. So our focus today is a concept called margin pressure and its impact on Tesla stock. So please remember to like and subscribe, and thanks once again for joining us. So one of the things that's been going on is that we had a huge amount of success with our predicted 100% gain in Tesla stock price, and it's really fun to maintain that once it happens in terms of knowledge flow. We had targeted something like a $240 price target for the stock, and it sort of got into the 217s of the highs in the recent weeks, and it sort of pulled back just below, 200, maybe the high 180s is the range we're kind of in currently. And so I wanted to do a show which collected up some of the facts that were going on to sort of make a conclusion about where we're at. So the first thing that I wanted to review is that our amazing run was kind of driven by a number of factors, as you know. The first one is that obviously Tesla came out with earnings and revenue number, and kind of two things happened. One is that after earnings, Elon actually announced that they were going to cut prices, and then that price cut gave a nice push in stock price to Tesla in a kind of both in Europe, US, as well as in China. That was good news. The other thing that happened that I am really excited about for Tesla is the fact that we learned that the Joe Biden led initiative for incentives relative to electric vehicles came out in favor of domestic manufacturers. In this case, what happens is that if you're a US manufacturer of EVs, you get access to that $7,500 tax credit. And the result has been a pretty dramatic bump to the prospects of domestic manufacturers. Obviously, Tesla is the number one manufacturer. Ford is still in the game, as well as GM. GM, not too many cars. So with the dearth of manufacturers and Tesla being the leader, I just think this ends up being really a Tesla incentive if you look at it carefully. We actually were kind of preparing a show based on the fact that the folks at, I guess, Kia Hyundai were targeting a real boom in this business this year based on that tax credit, and the fact that Joe Biden had said that, don't worry, we've got your back, and that that process didn't really work out. So the next thing we wanted to review is there is an analytical point that will play out over the next 3 weeks focused on margin pressure. So yes, Tesla is enjoying a return to growth in demand and a growth in revenue, but the problem with stock prices is the growth in your earnings is what determines the value of your stock, not the growth in revenue so much. That's a part of it because obviously revenue generates higher earnings. But the challenge right now is there's a marketplace unknown. There's like a $4 price target for the year in earnings for Tesla prior to the price reduction. Now we've had the price reduction, but Elon during the investor day didn't offer any updates on what was going to happen with margins. Now, I've searched around a little bit and I'm hearing something that I'll share that I hope is true, but I'm skeptical. What I've heard from sort of well-informed folks that are related to Tesla is that the price reductions aren't going to be a big deal. What do I mean by not a big deal? Well, if you have a reduction in price and you have a growth in your margins in terms of your cost of goods sold are falling, you can actually lower price and still earn the same amount. Now, is this going to happen? My answer is I hope so. But what I believe is occurring is that the markets are kind of discounting earnings growth for Tesla, hence the current price we have related to this. And so it's a big question that will be answered soon. The next issue is that the because of this sort of pressure on profit and the multiple for determining stock price works off of that profit number, not the revenue number. As I've said, we're kind of stuck in this wait and see from Elon to tell us, well, what are the margins going to look like now? The theory is that economies of scale in every aspect of what Tesla does yields this great number, and we're in good shape. What I think is going to happen, I just can't see how, when you go 20% light, they could maintain their margins. But if they've pulled it off, it's definitely a miracle, and we'll see nice results in terms of what happens to the stock. The next thing that I wanted to review that we're getting no answers on from Tesla/Elon is, well, what's going to happen with, there's a boatload of initiatives that could dramatically improve what these numbers are. Number one, is the Cybertruck going to be in June as planned? If so, we know that those numbers are going to be not a heavy flow of vehicles initially, but their arrival leaves the potential for that number to grow. In the short term, analysts won't be that excited, but those in the longer term, bigger firms will be targeting higher prices with this new revenue stream with solid margins, particularly early in the game. The next issue that pops up is that, yes, the markets were down today, but Tesla also announced some price cuts relative to the highest price Model X and S vehicles. They represent a smaller amount of profit and revenue. That per car is probably higher in profits, so they could afford to cut there, and it's not a big deal. But it is big news whenever prices are cut, because this further affects this whole conversation about how are we doing in terms of pressure on earnings and therefore pressure on stock price. Now, the final thing I wanted to close with today is that I had a business school class once, and our professor explained, in this case at Stanford, and our professor explained that one of the phenomena of business is the fact that anytime a company hires a consultant, it's often the case that the company knew what the consultant might offer in terms of information, but by having the suggestion made by the consultant, not the company, it gives cover to what's going on within that corporation. So I bring this up today because I may choose to do more of a show on it, but as you know, we recently had the former head of operations in Shanghai come with, a small team to help jumpstart production in Fremont and in theory in all of the factories, because he's been sort of made the number 2 of the company globally. Now, I have a sort of a bad prediction to make, which is I actually think that he's not going to last more than 6 months. And why do I say that? Well, one of the weirdest phenomenons of Silicon Valley is you have these really, really smart people, sub 30. They just blew the lights out on all their classes and just crushed all the numbers. But when they go into giant corporations, they have to wait for 30 years before anything they do or say has a significant impact on that corporation. Tesla's different. A lot of really smart young folks are at early stages of their career in really critical positions. When the CFO took over that position, he was 35 at the time. So one of the things I was told about is the fact that the reason why the former head of multiple parts of the company, Jerome Guillen, left was that he had a group of folks he was training beneath him. They're on the younger side, and they basically helped force him out of the company because that gave them a lot more opportunity to make big decisions and shine, and therefore we didn't see Jerome anymore, even though he brought a lot of experience having worked at Daimler prior to coming to Tesla. So my take on the arrival of this guy from China is that, yeah, I mean, if you think about the numbers, China is producing 20,000 vehicles a week. Tesla's at that Tesla facility, Fremont is theoretically around 10K, and then 4K from the other two manufacturing facilities for cars. Well, it's interesting now because the open question for everyone has been, why are we limited to 4,000 vehicles per week coming out of the two new factories when they're really built for the same 20,000-ish per week that would be coming in our operations, currently in China. And so it's my estimate the reason for the slow ramp is 4680 is slowing things down because there's only so many batteries coming out under Tesla production of that. The Berlin facility is at 4K, is what we've been told as well, but they're not doing 4680s, so in theory they should be able to ramp faster. It would help a lot because it's a huge market, and those cars wouldn't have to be shipped from China. So it's my assessment that Tesla / Elon is really experimenting with a lot of different manufacturing ideas. And the more you experiment, it requires, delays and up ramp after the delays, and that can affect whether or not you can produce more. The argument that flies against this is that they actually are, or just did, add a third shift in Germany to facilitate more production. So in theory, I guess that could be an answer as well. But regardless, when your break even is about 2 to 3K a week and you're doing 4K, that's good. There's profit coming out of that baby, but not enough to shake a stick at. So I believe the new head from China is here short term because, those folks want to take over and make the decision themselves. And Elon has a very open, sort of grab the mantle if you can set up in terms of managers. Whenever I take a look, I don't know if you've seen him, but the new head of the Tesla Semi project, very, very bright guy, I want to say late 30s, early 40s. And I keep wondering, experience-wise, given that Jerome Guillen had been on board from the early days and all the way to take over the Semi, and that's his expertise area, I was just blown away that he was able to help move Mr. Guillen out and take over that position, given all the expertise that Tesla loses when he left. Interesting set of challenges for Tesla to manage those really brilliant people that they're hiring from everywhere. So overall, I would say that the conclusion of our show today is just the fact that, yes, Tesla stock price is not peaking where we thought it would. I believe, obviously, the market is influencing that with interest rates, but we also have the problem of the fact that lower margins that are unconfirmed in terms of their impact on earnings cause the target numbers for Tesla to actually fall, even though we're seeing more cars sold and revenue rising. At any rate, that's the end of our formal production for today. I want to next move off into a discussion of our health tip for the week. Just a reminder, 25 legless a day per leg is a wise move, but also emphasizing don't go to bed within 2 hours of eating, minimum, ideally 4 hours to let the food digest and you don't have stomach acid trying to digest you. Anyway, this is Greg for Teslafaninsight. Thanks once again for joining us. Tschüss German, au revoir French, Lehitro Hebrew, Choda Hafiz Farsi, Zdravstvuyte Russian, Ni hao ma, Chinese, Konbanwa, Japanese. And in Jamaica we say enough respect, walk good man. Thanks and have a great day.